Hi, today we're going to be talking about cash control systems, Chapter 5 in our college accounting course. In Chapter 5, we will be discussing the use of the checking account as well as a petty cash fund. We will also be discussing accounting concepts and practices related to using a checking account. We will be discussing business papers that are related to using a checking account. We will work through bank reconciliations, and we will journalize dishonored checks and electronic banking. Lastly, we will learn how to establish a petty cash fund and to manage one. When we think about a business, we think about how a business on a daily basis has to deposit checks. They have to deposit cash. For most businesses, depositing cash is very much a daily occurrence, especially in large businesses. When businesses deposit cash, they list all the checks that have been received into their business on the cash deposit slip based on the bank routing number, which identifies the bank on which that check was drafted or written. Businesses typically deposit their cash into a checking account, and from there, their business managers, their cash managers, typically called a treasurer, manages that account. The checking account is just simply by definition a bank account from which businesses can make payments or order payments to be made. Cash transactions themselves are the most frequent form of transaction for a business. Therefore, there's the most chance of errors that affect the cash account more so than any other account. That's why it's so important from a business standpoint to make sure you balance your cash position and reconcile your bank accounts on a frequent basis. Keeping and maintaining records of all the cash receipts and deposits for a business is what we call a proper accounting procedure, and it helps to safeguard the business's money. Additionally, keeping receipts from bank deposits or for bank deposits is an example of the objective evidence rule, so that businesses have objective evidence for any deposits that they have made. So simply speaking, we have our checking account, and then when we want to order our bank to pay another party, we use what's called a check to make that order. A deposit slip is used each time cash or checks are deposited into our bank account. So here we see our business, Techno Consulting, is depositing money into its account. It is receiving that in the form of checks from another business for $5,000. And the routing number of the check that it was received from is 24-108. Depositing cash, as we mentioned, should be done on a daily basis for a business. And as we indicate here, the checks are listed based on the routing number. When we deposit money into our bank account, we record that deposit on what we call the check stub. We already briefly discussed the check stub in a previous chapter, but here we're going to spend quite a bit more time looking at and working with the check stub for our businesses. But as you can see here, not only did we on the previous page use a deposit slip for that deposit of $5,000, but here we're going to show that we're going to record that deposit on our check stub in our checkbook. So what we do is we note here that the balance brought forward is $0. There was no balance prior to start of our business. Then on August 1st, we deposited $5,000, and then we have a subtotal of $5,000. When we receive a check, there are different ways that we can sign or endorse the back of the check. The endorsement is just simply a signature or stamp on the back of a check transferring ownership of that check. There are 3 different types of endorsements. The first type of endorsement is called a blank endorsement. It only has the signature of the endorser. A blank endorsement should really never be used unless you are standing at the teller's window ready to cash or deposit the check. The reason is that if somebody were to pick up that check once it has been endorsed, they can go into the bank on which the check was drawn and simply cash it. That endorsement, without any other specifications, really allows that check to be used as if it was cash. The second type of endorsement is called a special endorsement. This particular type of endorsement states the name of the new owner of a check. This is when we're basically transferring a check from one party to another party. So on the front of the check, it might have been issued to Kim Park, but on the back of the check, it was transferred from Kim Park to Eleanor Johnson. So when we're doing a special endorsement, we put pay to the order of, and then we put whom we're paying that check over to or endorsing that check over to. The third type of endorsement is a restrictive endorsement. This is the safest type of endorsement. When we put a restrictive endorsement, it basically restricts that check to only being deposited. It will say for deposit only to the account of Techno Consulting and be endorsed by an authorized party or representative of Techno Consulting. We would typically also put the account number for Techno Consulting on there. So we would put for deposit only to the account number of 0000, whatever it is, and then Techno Consulting, and then we would endorse it with the name of the authorized person for that business. Now, the next step is going to be how would we actually handle writing out a check? First thing we're going to do when we have to write out a check is we're going to complete the top portion of the check stub. The top portion in this particular instance, it says is for check number 1, and it's going to be for paying Port City Supply Company. So we're going to first write the amount of the check. We're going to then write the date of the check. We're going to write who the party is that we're paying, what the purpose of the check is. So in this case, it's for supplies. We're going to write the amount of the check down here below. And we're going to put then the balance of the account after that check. What we notice on our check stub are a couple of things. We've got our information up here in this top portion, okay, including our amount, our date, who we're paying, what it's for. And what we need to do is we need to bring that information down below into the bottom half where we're calculating what the balances are in our checkbook. So what we're going to do is we're going to, if you recall previously, we had indicated that up here we're putting the amount that we deposited. We now bring this amount down, this subtotal amount down to here. We don't have anything going on here, so we don't have to worry about that. But we have to bring the amount for this check, number 1, and we're going to bring it down here to the amount of this check. Now, if our previous balance was $5,000 and we write a check, it would be expected that the balance in our checking account is going to go down. So we're going to subtract the amount of this check and get a new balance for our check on our check stub. This balance should also match our ledger balance. And then also, if we were doing a bank reconciliation at this point, it would match the bank reconciliation, this $4,725. So the stub is completed before the actual check is written, and then the check becomes a source document for the journal entry relating to paying this supplier, Port City Supply, for those supplies. The next part of this is going to be to actually write the check itself. So when we write the check, the steps in the check writing process include, now we're going to write the date. Again, that should be matching the date on the check stub. We're going to write the name of who we're paying it to, paying to the order of Port City Supply for $275. We're going to write the words for $275 on this line right here, the second line, and we're going to make sure that the $275 starts out here to the left, and we're going to make sure that we include a line after what our cents are. So we write the numbers out in words, and then in cents we put however many cents, in this case it's 0 cents over 100. And then we draw a straight line across for the balance, to fill in the balance of the space. This is so that nobody can accidentally slip in some additional words. Okay, then we're going to put a memo in the, we're going to write the amount in figures, write the amount in words. We're going to write the purpose of the check here, and then we're going to sign the check. The person who signs has to be an authorized signer for that company. And then a little note here, post-dated checks. Post-dated checks are a check with a future date on them. Most banks won't actually accept any post-dated checks because the money can't be withdrawn from the account until that date. So for instance, here, this check is written on August 3rd. If we didn't have funds in our account and we wanted to write this check out so that the party, Port City, couldn't cash it until August 5th, we could write the date August 5th on here. However, the one problem with that is it's technically illegal to write a post-dated check or a future dated check. The reason for that is basically you would only write a future dated check if you didn't have the funds in your account to write that, and you know, it's considered to be fraudulent if you write a check for monies that you don't actually have. So you should never write a post-dated or future dated check. Let's say we made a mistake on our check and we needed to void it. We would write in big words across the check, void. We would put a void on our check stub, and then lastly in our journal we would write the date of that check and we would write void on the line. We would put the check number, and then we would indicate that no funds were taken out. And then we would put a check in the post reference column because we don't have any other, we're never going to post that void check to our ledger. There would be no impact in our ledger. And that's it for section 5-1. We're going to do another short presentation on the work together for 5-1, and you guys will have APLIA 5-1 for homework.